Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, May 1st, 2012. And tonight I'll be posting some longer term index charts looking at the NDX, S&P 500 on both the weekly and monthly time frames. And as I was putting together the first of those charts here tonight, we're looking at the NDX weekly chart, the Nasdaq 100. I figured it would be a little bit easier to do a video overview on this because there are so many nuances, if you will, on this chart that are much easier explained through one of these video updates than trying to annotate this chart and get all the points that or the things that I'm seeing on this chart, trying to convey that out to you folks out there. So let's start with these lines here. As you can see, I've added some horizontal yellow, orange lines, and what I'm marking, let's go down here. This is the RSI 14, the red line being the 70 level, which is considered overbought. Readings of 70 or above are typically considered overbought readings, and the line down here is the 30 line, which is considered oversold, readings of 30 or below. What I've done is marked all the readings of 70 or higher with these yellow lines, and wanted to point out what we've seen following those readings. So let's move here from right to left. For the most part, when you have these readings of 70 or above on the weekly time frame, the RSI, you're looking at best very little upside, maybe some flat sideways trading for a few weeks, but more often than not we're followed up by a pretty significant correction. And to gauge how much that is, well, here's a scaling over here. You can pull this on your own chart. I try to replicate this, but these are pretty substantial downtrends. So not only could one profit quite a bit by shorting, getting on the right side of the of this trend and shorting it down, but at the very least, I do know there's a lot of traders out there, and particularly longer-term investors, who are not comfortable with shorting the market. So the takeaway from this would be, when you see readings like this, it is time to tighten up the stops on your longs, maybe be much more selective on taking new longs, or reduce your portfolio altogether. There's nothing wrong with putting money into cash for short term and protecting these profits. So real quickly, if you follow the cursor down, you can see that one lasted, and of course here's a scaling, so we're talking several months of a decline in most cases here. Here's another reading, and keep in mind we're looking at a weekly chart, so anytime you have an indicator signaling a sell signal or beginning to look bearish or bullish, those can take weeks and sometimes months to play out. But as history shows us, usually the corrections followed pretty quickly here and lasted for a while. Here is a case back in early '06 where we had the RSI reading of 70, had a little correction, the market pushed up to make a new high, and if you look closely here, you can see that was the peak. We tried to rally up again and match that high, fell a little short. And so once again, keep in mind that you would be removing longs or shorting here, giving yourself a little bit of stops, and over time in the past, more often than not, you've been rewarded. Here's a period where you might not have made a whole lot by shorting, but again, if you would have gone to cash, you would have saved yourself a lot of angst by sitting in a sideways market that chopped around for a few months and then of course ended with a big 1 month big red down candlestick before the uptrend continued. So that would have obviously shaken out a lot of longs, or at the very least frustrated you. You can go on and look, some of these happen quick, and then the markets went on to make a new high. There's a quick drop, and of course here's the high back in 2007. That would have been a great one to get on the short side and ride that all the way down. But again, the history is pretty clear. Even that nice sell-off we had back in 2011, the market peaked back in May I think it was May 2nd was the official high on the market. And yeah, had you pulled all your longs out of the market then or shorted, you would have had to give the shorts a little bit of time to really play out. But as you can see, even though we did go slightly higher just before the big plunge in October, that was only a little bit higher, and the ensuing sell-off was quite a bit. And here's where we're at today, and you can see we recently, as I pointed out a few weeks back, hit that sub or 70 reading, a little bit above 70 I should say. One other thing that I threw in here is the MACD crossovers. With any indicator, if you can add on a second or third confirming indicator, it sort of helps take out the whipsaws. And what I'm looking at here, two things. I'm on the MACD line. You can see some yellow or orange circles. These are bearish MACD crossovers. By bearish MACD crossover, I'm referring to the fast line moving which is above the slow line moving under that slow line. That's also illustrated here below. If you look at the red bars down below, this is the MACD histogram, which is another way of getting a good visual on whether or not you've had a MACD crossover. And once again, these are not exact timing indicators because we're looking at a weekly chart here. Going back to this first line, the MACD was so flat, so that one it's hard to really get a clear signal on, and that might be because I believe this chart started just to the left here, and sometimes you need a little bit more history to get a good reading on the MACD. But either way, let's move forward, and as you can see, you had your 70 plus RSI reading at this level, and the MACD crossover shortly thereafter, confirming. And you could have waited to this point, shorted, still got in, and made a good deal of money. Again, we had the 70 plus RSI reading, and this one is very hard to see. I imagine in this video, I don't know what size you're viewing it in, but if you look down at the histogram below, we did have the cross right about at this level. So that would have put you, or confirmed a sell signal at this point. Yes, the market pushed a little bit higher, and then a nice sell-off ensued. And again, go down the line, and you can see here that I've circled all the MACD crossovers. And now what's interesting is I didn't put a dotted line here. This is the only time the RSI came up from below to hit that 70 level, and this chart spans all the way back to late 2003 that you're looking at. So we had an RSI reading here of 70 or above, and yet the market just kept on going. A couple things on that. Number one, this was a period of unprecedented liquidity being injected into the system by the Fed, which has really played a tough time on a lot of the technicals, especially in that period. But more importantly, we were coming off extremely, nearly unprecedented oversold levels from this panic sell-off down into the March 2009 lows. So the market had a tremendous amount of momentum into it, and this was a period unlike many we've ever seen in history. With that being said, we still had the signal, and if you look at this arrow here, what I noted is the MACD itself never had that confirming crossover until after we had the RSI push down and again push back up for another 70 plus reading, and then afterwards, and again this is most clear by looking at the MACD histogram over here, because the MACD did flatten out quite a bit. And that may be what happens here. It's very possible. If you want to look at the bullish scenario, we have not yet had a MACD crossover. So although we have had the RSI 70 plus reading, the MACD is pinching in a crossover. One would say it's pending, but until it happens, we're still, the MACD is still in bullish territory, although looking a whole lot more bearish as I speak here. And another thing to keep an eye on is this trend line, what it looks like a trend line off the 2009 lows. We had a breakdown here last year, 2011, pretty impulsive move down into the October lows. Markets pushed back up, made a retest, which is typical, and yet we have another retest. So at this point, we are once again, or we have recently, I should say, tested that line from below. So we have a couple things that help confirm a longer-term bearish case, a possible inflection point. Uh, doesn't mean the market has to drop down and take out the 2009 lows. It's just too early to say how far down we might go, but we have a lot of empirical evidence here showing that a rejection off this trend line, the 70 plus RSI reading, soon, if things continue, if we have any more weakness in the broad markets, we'll probably have a MACD crossover as well, further confirming that. So now we go back, where are we in 2012? So we run all the way back to 2003, and we had, if you use the MACD filter, virtually, well, we haven't had any false signals. So again, looking at the RSI crossover followed by the RSI 70 plus reading followed by the MACD crossover, and the message that I would try to impress here is my guess is at best, if the market does not go down from current levels over the next few weeks to months, at best it's going to be tough sledding on the upside. So keep that in mind. The market may have a difficult slog here trying to get up and make gains, 10, 20, 30% additional gains from this level. Okay, that's a little bit longer than I wanted to go over on this video, but hope this made sense. Thank you.